So, ladies and gentlemen, there you have it. We are now going to go into our panel discussion number 2, and we're going to get Prof to lead the way, all the way. Let's go.
Thank you so much. So welcome everyone to this our second panel discussion of the symposium. I'm Prof. Dave Fernandez. I am a professor at the SMU Business School, and I'm also the director of the Simkey Boon Institute for Financial Economics. I brought on a new title last year, which is very relevant to this panel. I'm the co-director of the Singapore Green Finance Center, which is a joint project together with SMU and Imperial College London, supported by the Monetary Authority of Singapore and 9 founding partners who are financial institutions, both Singapore-based and global. So we're very excited to spend the next 50 minutes or so talking in this symposium on financial literacy about a relatively new topic of sustainable finance. So the title of the panel is Financing a Sustainable Future. And you've already heard some introductions for our panelists, but we're gonna go through them again a little bit in the sense of, I think it's good to place everybody and what they're bringing to the table here. But, Singapore, so we have acronyms for everyone. So we'll go slowly a little bit through the acronyms. Cheryl, Chen is at S&P Global, Standard & Poor's. Jeanne Stampe at MAS, which of course is the Monetary Authority of Singapore. And Anders Nordheim from WWF, which is the World Wildlife Fund. Now, these all should be well known to everyone who's attending this symposium, but I want to go back through our panelists again and give you a little bit of their titles. I told you that last year I took on a new title as co-director of the Singapore Green Finance Center, so that's new. When I joined SMU, that was not a thing. And if you look at the titles of our panelists, once you get past the acronym, which is the institution that they are a part of, Cheryl is the director of corporate responsibility and sustainability. Jeanne is the lead resource for green finance. Now, Anders heads up the Asia Sustainable Finance Group at WWF. These are relatively new, that these ideas of sustainable finance are becoming and are spreading out across the industry. And so that's what we want to talk about today in this panel, because anything that's new, the theme of course is literacy and education, anything that's new, we want to make sure that everybody knows about, in this case, knows why it's a thing and why it's new, but very importantly, how to get involved if you want to be involved, coming in with knowledge about what this space is all about. So that's the idea for the panel today. But we're going to start out with a little survey for the participants here. I see about 250 or so of you there, so hopefully we can get some good response. So we'll kick off with the survey. Can you please put the survey questions up? Or question up, there's only one. See. Okay, so the question is in front of you. Is it worth paying higher fees for a mutual fund that makes only ESG sustainable investments? Okay. So is it worth paying higher fees for a mutual fund that makes only ESG sustainable investments? That's the question that we're going to come back to see how you as our participants in the symposium are thinking. Is it worth paying higher fees for such an investment that only makes ESG sustainable investments? Now, we've got to take a pause there, make sure everybody knows what ESG stands for. So ESG would be investments that take into account environmental, that's the E, social, the S, and governance factors. So investments that take into account environmental, social, and governance factors. Okay, so let's dive in right away with our panelists. Anders works at the WWF, And we want to start out with a very big picture, Anders, because here we are talking about broad financial literacy, a lot about technology, a lot about new investments and new ways to invest, how to manage risks in a very broad, generic sense. And all of a sudden, here's this panel on sustainable finance. What is the big picture where this idea of sustainability is becoming a critical factor for everything in the world, including for our investments? Can you paint that picture for us, please, Anders?
Sure. Thanks very much, David, and hi, Jeanne. Hi, Cheryl. Thanks for allowing me to join the panel. So, I mean, you highlighted some of the trends that we're seeing around sustainable investment or ESG investing, whatever label you want to put on it. But fundamentally, this comes from our sustainable development objectives. So these are at the moment manifested in the Sustainable Development Goals, which are set up by the UN. A series of goals that we as humanity want to achieve by 2030. These goals incorporate things like climate change aspects, addressing nature loss, but also social goals like addressing inequality in various areas. And we have these objectives as humanity because we want to be able to have development in a way that doesn't compromise the natural boundaries that we have in the planet, the boundaries of natural resources that we see, but also because we want fair and equitable development within countries and also across regions and across the world. Not just because it's a nice thing to have, but also because if everybody is able to enjoy prosperity, it creates a better and more harmonized society. So those are the sort of fundamental objectives that we are talking about, and those are enshrined in international agreements that we all strive towards. Now, how does this link to financial institutions? I think there's recognition that these issues cannot be solved by governments alone. They cannot be solved by individuals, that corporates, companies also have a fundamental link to solving these issues. How do you choose to produce? How do you choose to consume? What does your supply chain look like? And we know that a lot of the mess that we're in today is because of the choices that the companies and consumers have made in the past. Now, partly maybe through ignorance or partly because there wasn't necessarily a need to change behavior. And now there is a desperate need to change that behavior. And we know that there are some parts of the economy that will not be part of the future, such as coal, energy production. And there are other parts of the economy where we fundamentally have to change how we produce and how we consume. So finance enables all of this. And finance is not agnostic in what it chooses to finance. It's choices that are made in financial institutions by finance professionals every day, and in some ways also influenced by regulators and other bodies. So finance has the ability to also influence what the future looks like. And this is essentially what sustainable finance is trying to do. Now, financial institutions will approach this from primarily two perspectives. One is from a risk perspective. So how does climate change, how does nature loss, how do societal patterns changing affect my lending and investment? If there's increasing flood risk in a certain area, does that affect the lending to companies that I have there? It also affects we call it sometimes refer to it as a double materiality, where it's the risk on the financing, but also how financing impacts nature and other aspects. So if you finance a particular activity like a new copper mine somewhere, how does that impact on nature? And how does that affect the communities around this particular economic activity? Because no economic activity every economic activity has an impact on nature. It's really about how do you manage that impact and how do you make it aligned with the objectives that we have as a society through the Sustainable Development Goals. So it's really exciting to see that this is such a big topic these days.
Indeed. Thanks so much, Anders. I mean, I'm going to turn over to Jeanne for her perspective on this, big question, big picture question. Why are we here? What's this all about? Sustainable finance.
Sure. Well, I think that all finance actually needs to be sustainable. If you talk about factoring in sustainability risk for the resilience element. So, climate change, natural capital, these are existential and urgent threats, right? So they put businesses, they put the finance sector and the financial system at risk, right? So we see that increasingly financial institutions understand this, and as well regulators, so as supervisors. So you have additional safeguards in place and regulations to create a level playing field. And you see within Singapore, for example, MAS in December last year issued guidelines on environmental risk management. So these guidelines are meant to strengthen the financial sector's resilience to environmental risk. And these guidelines, they differ from other jurisdictions because they go beyond just climate change, and they focus on the widest spectrum of environmental risk, such as pollution, a loss of biodiversity, and land use change. And the guidelines set out our supervisory expectations for banks, asset managers, and insurers to assess, mitigate, monitor, and disclose environmental risks. So these guidelines basically help uplift the environmental risk management standards across the Singapore financial sector and contributes to climate mitigation and the protection of natural capital. Of course, MAS is not the only banking supervisor or insurance supervisor to have put out such kinds of guidelines. So we are also a member of the Network for Greening the Financial System, which has most of the world's largest, or even some of the smaller countries as well, the central banks and supervisors, who have joined this platform to share best practice and to push the thinking on how best to protect the financial system from climate change, and also how can the financial system contribute to some of the solutions. Because Anders mentioned earlier that governments can't do this alone, or even the finance sector can't do this alone. And we look at the gap, right? So just to achieve global sustainable development and climate objectives, the G20 has estimated that we need about $6 trillion a year over the next 15 years. But the shortfall is about 2.4 US trillion. And in APEC alone, the shortfall is 1.5 trillion USD. So the finance sector can't meet this alone. But together with the governments, say the public-private side, then there is a chance of being able to fund these activities, these policies, these objectives, and to actually have some chance of success.
Thank you so much, Jeanne. So Cheryl, you're currently at S&P. You were in the private sector at Citi before, so we're very familiar with you. And thanks for the support for many years from Citi Foundation for this symposium. What is your perspective from S&P, from the private bank side of things?
Thank you, Prof. Dave. Firstly, really glad to be here on the panel, especially on this topic, together with Anders and Jeanne. If we start with the definition of sustainable finance, the fact that sustainable finance doesn't really have a standard definition is a double-edged sword. On the good side of it, there's definitely been a proliferation of instruments in the space, both in the types of instruments and the record funds flow. We have green bonds, green loans, sustainability-linked loans, and now we have social bonds, transition finance. And since 2015, the market has seen a 10-fold increase in new investments in ESG fund and 8-fold increase in sustainable debt issuance. And according to our latest ratings research, we forecast that the sustainable bond market will reach US 1 trillion this year, doubling from last year. And 1 trillion is a million. That's, one followed by 12 zeros. The proliferation is a good sign. It shows market interest and attention, business case, and ultimately channeling more funds and capital towards doing less harm and doing more good, right? To borrow, Standard Chartered's excellent tagline. And in very macro terms, aligned with today's panel topic, financing a sustainable future, basically any capital that is allocated towards the goal of a sustainable future is sustainable finance. And as Jeanne mentioned, we have that financing gap of 2.5 trillion per year to achieve the SDGs by 2030, as is mentioned by Anders. However, the lack of a standard definition, not so much for the term sustainable finance as a whole, but for different financial products, especially for standardized product labeling and reporting requirements, can be quite tricky. I'll just raise an example. For asset managers and investment funds, investing according to a certain set of ESG criteria is also considered sustainable investment. They can exclude some of the companies with clearly harmful practices, put together a group of companies across industries that has an above average ESG score and label that as an ESG fund. But then there's also another type of ESG fund that channels funding only to green and social and sustainable projects. So which is the real ESG fund here? One is doing less harm, one is doing more good. It's getting a little bit confusing for institutional and increasingly retail investors as well. And of course, record growth of asset class and funds flow aside, there are definitely very heartening developments in the space on doing less harm. All of our key Singapore banks, UOB, DBS, OCBC, has made commitments to stop any new coal financing, and DBS is phasing out any coal exposure by 2039. So there's no stopping of the momentum of sustainable finance. It's more of how to truly leverage it so that we don't fool ourselves into thinking that we are doing more good, or we are doing the right thing, or we're doing enough just because we see more things with the ESG or a sustainable tag on it.
Thanks so much, Cheryl. So, I think this is those opening remarks from everyone really do help to motivate and set the stage, tell you why we're here, what we have to talk about, what this very relatively new but extremely important topic is for all of you who want to make sure that you are fully financial literate. Now, so, we heard from Anders this, the fact that the world as a community is agreed on certain principles that need to be pursued in the very large picture, and how finance plays an essential role in achieving those goals. And Jeanne is talked about then. I love the phrase, that sustainable investment is in finance is just finance that actually now properly takes into account all of the other economists refer to as externalities, other things that activities were spilling over in a negative way on the rest of society, and now we are taking those things into account. Cheryl talked about the money flow, and I think it's really important for all of you on this call. This is not just sort of pie in the sky. We want a boutique. We want to help the world, and so a little bit of our allocation should go to it. The money is flowing. I rejoined academia from SMU after 20 years with a detour, 20 years detour in the private sector. It was very clear that when the funds flow globally in the way that they are now, you better pay attention. And this flow is not a flash in the pan, and it's almost certainly only the start. So all investors, all of you looking at how you should invest at this beginning of your investing career, really need to pay attention to this trend, and it will, I think, eventually become the case where that thorny definition of a sustainable finance that Cheryl was wrestling with you won't have to deal with it anymore. It'll just be finance, because properly finance should take into account investments, should take into account all of risks and, importantly, opportunities that are out there. And we won't have to label them as something different, but we are at the beginning stages of it now, so it's very appropriate that they're labeled as such. So let's go to our survey. I think the results here, would you, again, the question was, is it worth paying higher fees for mutual funds that only make ESG investments? So if you look at the, I like to look at the disagrees. Folks who say, no thanks, right? I disagree. That's about 16%. I love it. So let's just focus on those folks who say I disagree. This is a question actually that on a broader survey that I've done with a colleague, another academic in the United States, who runs the Global Financial Literacy Excellence Center. And we'll be getting together, by the way, a little advert in November with those same teams to push financial literacy on the academic research further. So please look out for that. But we did this survey in Singapore, and we did this survey in the United States. And this number that's on the screen here for the disagrees, about 15%, is pretty consistent with what we found in the overall Singapore population in the survey. Any guesses as to what the Americans said? How many disagreed? What the percentage was for the US respondents to this question? Higher, lower, about the same? I'll ask my panelists. Anyone want to take a guess? Jeanne, Cheryl?
Probably
what do you think?
About the same.
About the same? The Americans are really cynical about this question, so they don't want to pay. So about a third said no, not worth paying higher fees for ESG funds. And again, I was very pleasantly surprised to see that the Singapore population overall, we can see it here, there's agree, there's sort of some in-betweens, obviously, but 42% agreeing is a huge number, right? We're talking about, the question says, paying more fees, right? And so I think this really motivates this, this panel, because as we've heard, they're very good reasons. They are compelling, there are essential, reasons we need to do this in order to save our planet. We need to take action. We need to have a more just and equitable world. And look at this, people are saying they'd be willing to pay more in order to do it, which goes back then to the importance of education and transparency and knowing what you're getting into. Because if you're going to take that step, you really need to understand what's happening. Jeanne?
Yeah, I was going to say, what were people told about the risk-adjusted return, and what did they understand by the term ESG sustainable investments? Because most people assume it to mean impact investing, whereas if it's basically financial returns, but only in the sort of solutions investing, if you will, and there are similar returns, and actually on a risk-adjusted, because it's lower risk, typically, on a risk-adjusted basis, it's actually a better investment. So if that is the premise, then I think the answers might be slightly different.
Absolutely true. And this is where, this sounds like an academic conference now, where you're going to get grilled on everything you put out there, which is great. Unfortunately, I have to postpone the question only because we haven't published our results yet. We'll be circulating those. But I should tell you that this is embedded in a financial literacy overall survey, of which Prof. Anna already is sort of globally famous, of sort of cross countries looking at financial literacy broadly. And now we're trying to drill in on this ESG leg of it to see, number one, are investors interested? And number two, very importantly, are they literate in that area as well as having broad financial literacy. So hold that, and it is. But I think to me, at least the broad message is people are saying, yeah, I mean, this is something I would actually be willing to consider, and maybe even to pay more for, which I find to be very encouraging. But also, once again, I want to worry a little bit and make sure that people know what all this means, and that's. I'll move on to that now, because these sound very nice, these ideas, but how do we measure and how any of the progress? When you say you're not supposed to do something, or don't do too much of something, or do something positive, all these things require measurements. And then if you're able to measure, you have to set a standard. Was that good enough or not good enough? So on the question of measurement and standards, we get to the phrase, okay, this all sounds good. How do we make it practical? And I'll turn to Cheryl first for that.
Thanks, Prof. Dave. There has been key developments and good momentum in the private sector. Every other day you see an appointment of a CSO, a net zero target, or another sustainability report. But we all know that there's a yawning gap between long-term net zero targets and near-term action plans. In ESG disclosure, there's also been an increase in quantity, but not so much quality. We really need ESG data and disclosures to be consistent, comparable, credible, and concise, right? And there's just 3 areas that I would like to highlight. Corporate action, consolidation in the ESG space and players, and collaboration amongst the international reporting frameworks. So 3 C's, being a Singaporean, sometimes we can't help ourselves but to go to such acronyms. So on corporate action, beyond ESG reporting and sustainable finance, it has to boil down to the actual corporate actions and ESG operations, policies, and performance of the company. This is what matters. The environmental footprint of the business operation for E, for S, how the company treats their employees, their customers, their suppliers, and for G, whether the company is well governed in terms of compliance and ethics. And a company should seek to be good rather than do good. And the ESG matrix and reporting will take care of itself. For S&P as a company, we've also set our net zero goal to be net zero by 2040. And in the short term, reduce our scope 1 and 2 emissions by 25% by 2025. And these goals are
I'm gonna
in
have to
alignment.
stop you there and make sure
Yes.
you clarify what that just meant, scope 1 and 2 for everyone.
Yes, scope 1 are directly generated energy, and then scope 2 are direct energy purchase. So it's really the energy that you're utilizing in the operations. And of course, scope 3 are the energy carbon emissions incurred in the entire value chain, whether is it upstream or downstream. And these goals are in alignment with the Science-Based Target Initiative and the scenario to keep warming to 1.5 degrees. We have also published our TCFD report and our 13th annual ESG report earlier this year. When we see across the S&P 500 companies, we also see more than 90% of them publishing a sustainability report, up from 20% 10 years ago. And there's also a growing consciousness that reporting is the first step, but to be credible and verifiable, there's a rise in audit and assurance in the ESG space as well. So now to the second point, consolidation in the ESG space and players. There's always talk about differentials in ESG ratings, scores, and assessment given by the different rating agencies. And I would perhaps, speak the truth. There are and will always be differentials, just as there are differences in a company's stock analysis by different trading firms and analysts. There's growth in the ESG assessment space and consolidation. For S&P, we acquired True Cost in 2016, acquired SAM of Rebecca Sam in 2019, Morningstar bought Sustainalytics in 2020, Moody's bought Vertigo Aris in 2019, and just last month bought RMS. And the consolidation of these big ESG players will help as we would arrive at a few large key ESG assessments and scoring frameworks, rather than many small ESG assessments and scoring framework. But the third and most important development is the collaboration across the key international reporting frameworks. And for industry observers, this is what we call the alphabet soup. Amongst the ESG reporting frameworks, we have GRI, Global Reporting Initiative. We have SASB, Sustainability Accounting Standards Board. We have IIRC, International Integrated Reporting Council. And over the last 2 years, you also have your big 4 accounting firms working with World Economic Forum on the stakeholder capitalism matrix. GRI has been around for the longest time, reporting on financially and non-financially material matrix to a wide range of stakeholders. SASB entered the market in 2011, offering more financially material topics in an industry-focused classification. IIRC wants to integrate sustainability into the financial reporting framework. And of course, mid this year, SASB and IIRC has merged and now form the Value Reporting Foundation. And in a way, they are very, very complementary. One is more principles-based and one is more disclosure and matrix focused. But I'll just end with highlighting 2 promising developments. TCFD, the Task Force on Climate-Related Financial Disclosures, now is getting increasingly adopted by the public sector regulators. New Zealand and the UK have made it mandatory for the large financial institutions to report on TCFD. And finally, the IFRS Sustainability Board. The IFRS Foundation is building up the proposed new International Sustainability Standards Board, adding ISSB into the alphabet soup. And late last year, all of the standard players came together to propose how can their standards all feed into this standard that IFRS, which really kind of set the stage for. And really in the accounting world, even to now, we have 2 standards. We have the IFRS and the GAAP, right? Adopted by different geographical locations. So you would see, much momentum in the last few years, but the road to the harmonization of the measurements is really long and winding. There's more hope of harmonization in the public sector, Jeanne, across the different central banks and regulators. But it's also probably quite challenging there as well. Who is going to adopt what and why, who is the leader, who is the follower. So I'll leave Jeanne and Anders to comment as well.
Thank you, Cheryl. I mean, I think that's the one clear takeaway just from your remarks about the making it practical, especially for our audience. I want to maybe take a jobs angle to this. For all the acronyms and activity that Cheryl described, this is all new so every company that's doing this reporting, every financial firm, every asset manager, I can assure you, if you're looking for jobs after your university days in Singapore, this is a booming industry because we're all in this together, and that's one of the key goals of the Singapore Green Finance Center is to help build that pipeline of talent, because it's very scarce right now, and we hope all of you are going to join in these efforts that Cheryl described. I mean, what she described is right now in the eye of the storm as we're going forward with this. There's a lot of activity, and there's probably a lot of confusion as well sometimes, and there's probably going to be some consolidation. But I think, to me at least, and I'd have to hear Jeanne or Anders as a perspective on the current evolution of this space. It's all good. It's as though it's surprising that there's confusion in the investment world. That's sort of standard. But there's a huge amount of effort, and most importantly, to me, there's a huge amount of money that's moving and that's forcing the evolution of these systems. So I think it will take its time to settle down. But to me, it's encouraging. Jeanne, Anders, I don't know if you have perspectives on this.
Sure. I mean, I thought I could provide the regulatory supervisory perspective, touching on 2 points that Cheryl highlighted. So on disclosure, firstly. So whilst yes, there is the alphabet soup, and good news is that there is convergence. And the issue is that even when companies are using the same standard, the actual disclosures are not comparable. So, and the part of it is because the disclosure regime is not mandatory. Part of it is because it's not sufficiently prescriptive in terms of the actual standards themselves. So MAS is part of IOSCO, which is the International Organization of Securities Commissions, which did a study of the sustainability reports across 5 different jurisdictions and found that, you had, even within the same sector, there was a wide range in reporting with the same framework. So you could have, for example, companies in the energy sector, and they will be reporting using TCFD, but the net result would be rather different. So this is why the IFRS Foundation has come together to work on the International Sustainability Standards Board, ISSB, which should be launched around COP26 in November. And it will issue the ISSB will provide the sister standard to the IASB, International Accounting Standards Board, to create the linkages between sustainability and financial reporting, right? Because sustainability in its true sense is not CSR. It's about how you're running the business. Is your business future ready? Are you looking at how your full value chain, your stakeholders, what are they expecting of you? Because your business can only flourish, right, if others are also flourishing alongside you in some sense, right? So IOSCO's task, IOSCO is, our members are all the securities commissions. So IOSCO's task is to opine on the ISSB, and along the way, the prototype is being developed to give ISSB a running start. IOSCO will opine in terms of the fitness for purpose. So MAS actually co-leads the technical expert group that will be looking through the various the prototype package of standards in order to advise the IOSCO board on its position in the run-up, in the prototype in the run-up to COP, and also when the final standard is issued. And then that, if it's fit for purpose and if it's endorsed, if you will, or supported by IOSCO, it will be easier thereafter for these standards to flow through down on the ground in the jurisdictions where the securities commissions in each jurisdictions are the ones that decide what standards to adopt, whether it's mandatory, the speed. So IOSCO can promulgate the standard if it endorses it. So we hope that will be the case. And so MAS, we're part of a group of securities commissions involved in this technical expert group, and that hopefully will provide comparable, consistent, and reliable disclosures. So, this way, right, you'll be able to benchmark companies properly, and also if there are objective science-based parameters within the disclosure metrics, then you're able to also see what is the risks that the companies are exposed to. And similarly, what are the sustainable impacts or positive impacts that it's contributing to. And if you look at green financial products or sustainability linked products, having the benefit of the company level disclosure provides the investors with the full picture of a company. So if a company is issuing green bonds are use of proceeds assets, meaning that they're green because the money is used to finance green activities, right? But with the disclosure of the company, you can see how said activities are part of a hopefully credible transition path or sustainability path and strategy of the company. And this is just there's the funding to get to the end goal, as opposed to just looking at the funding itself. So with the disclosures are bedrock of the sustainable finance system, because they also flow and make taxonomies usable and make taxonomies interoperable between jurisdictions when you have underlying similar activity metrics like CO2 equivalent per kilowatt hour, or CO2 per ton of steel produced. A ton of steel is the same in any country. So you can have that comparability and can adjust for size, which then creates that scale, that common language, so that you can also have the significant amounts of cross-border green capital flows that are needed. I spoke about that earlier in terms of public money not being enough, you need private sector money.
Yeah.
So, and when you can manage the risk well, then you don't have, the hole in your pocket. And then you can have deeper pockets to provide the funding. But if you're not managing the risk, you're not going to, investors not going to be able to also finance the transition because they would have been nursing losses.
Thank you for that perspective. And I think it's so for everyone. I mean, obviously is understood that this is a global problem. These are global problems that we're addressing, but it's also a global financial system, right? And so when you're investing, you need to hear what Jeanne said. I think should really be very reassuring, to everyone in terms of the active dialogue, that globally regulators, standard setters are working, to make sure that all eyes, including not just here in Singapore, but everywhere, are working on the problem in a harmonious way. And it does, I understand, I'm going to jump in, and I don't know if you had more to say on this topic, but I wanted to look at it. I saw a question come in that I actually want to turn back on Jeanne, just because it fits in, you are on the regulator space. And one of the questions that came in is, okay, great. But how can we tell the difference between true sustainable finance products and greenwashing? So it's time to bring out the greenwashing term. Are we going to call people out? Is there going to be enforcement? How are we going to protect investors if they are going into these products?
Yeah, well, I mean, you're greenwashing, you're green wishing, and you're green hijacking as well. So there's a range right now, because green wishing being a little bit more benign, if you will. So, but the disclosures will go a long way, because if you look at how companies, if they're able to provide that robust disclosure, then the sustainable funds, even just so-called vanilla funds that they are looking at, they are factoring in sustainability risks, will be able to get across their portfolio for each fund the collective metrics, looking on a look-through basis, that can substantiate their green label or the sustainable label. So that is one way of so-called acting against or protecting against greenwashing. I mean, the other way would be the use of taxonomies. So taxonomies are basically, think of it as a threshold, right? So you can have a series of activity metrics, like I mentioned earlier, carbon CO2 equivalent per kilowatt hour of power generated. Then at a particular cutoff, that's where it can be defined as green. And a slightly lower cutoff, perhaps transition. So it's not yet green, but there is a plan in place to get it to the transition level. So these taxonomies are, again, a common language, right? Because you don't want it to be the situation where you have Nippon paint green and then Dulux paint green, and they're not the same green. So you can't paint one wall of your house and the other, and the mix-up looks funny, right? So this again allows for that interjurisdictional capital flow towards sustainable outcomes. And the taxonomies are also fragmented, a bit like the disclosure landscape that Cheryl touched upon. And it's not alphabet soup because it's typically done by the jurisdiction. The good news is that you have the International Platform on Sustainable Finance, IPSF. So it's aiming to enhance international coordination on taxonomies. And today it represents 17 jurisdictions across APAC, Europe, Americas, and Africa. It's over 50% of global GDP. So there is a working group of taxonomies that's led by the EU and China. MES is also part of this working group. And it's developing a common ground taxonomy. So it basically is looking through to the activities to see which activities under the Chinese taxonomy would meet the similar thresholds in the EU taxonomy and vice versa, because they are using slightly different standards and some are more stringent than the other. So there are different subsets, if you will, like some meet the Chinese, don't meet the EU taxonomy, vice versa. So by pulling through all of the common activities that tick the boxes on both, it will make it easier for an investor to, from Europe or from China to invest in each other's markets. So the CGT will be expanded to include other taxonomies that are being developed or widely used, so that we can have, if you will, a global dictionary of what is, or global standard in some ways, of what is considered green, and then also what's considered transition, right? Because not everything can be green overnight, right? So for example, if you look at steel and cement, there is no zero carbon steel. I mean, it's just unlike energy where you have solar and hydro and wind, You don't have that equivalent for steel, for cement. So that can never be in the green taxonomy per se, but it could be in a transition taxonomy subject to certain thresholds. So the taxonomy is the other way. Disclosure number one, taxonomy number two. The third way is through labels, right? So ESG labels or sustainable fund labels. And that's where, regulators put in place investor protection measures. So requiring, the fund manager to provide a substantiation, to explain exactly, or use certain terms rather than everybody saying, oh, I'm a low carbon fund, and then they've got coal-fired power plants inside, So be very clear and have that. Everybody has a low carbon fund, but it means different things to everyone. So again, having that requisite set of disclosures that the fund manager has to make about their product, so that it's very clear to the end investor, what am I getting into? What are the objectives of this fund? Is this fund actually a solutions invested fund, or is it just going to make sure it does no significant harm? Or is it in the midway, or is it just screening out the worst? So, it has to be very transparent. So same thing with ESG ratings, right? They have to be transparent. I agree, Cheryl. They don't need to be, the ESG ratings don't need to be exactly the same, because they're measuring sometimes different things. So we want that innovation in the market so that different providers are looking at something different. Some may be measuring the extent of disclosure. Others are measuring the strength of the policy or the performance. So as long as it's very clear again to the user of the ESG ratings, what is being measured, what are the metrics, and what's the weight applied to each issue being measured, then it's fine that they are different. But today, that transparency is not quite there yet, and the consolidation, it has caused a little bit of worry with the European Securities Market Authority, because of the power, right, that a small group of providers can wield, because a lot of money is moving towards the sustainable finance, or however you call it, finance incorporating ESG risks, etc. And the use of ESG data and ratings has grown tremendously. So there's the ratings, the data, they are influencing financial flows, which is why the ESMA and other regulators are looking at this. And this is also another piece of work that IOSCO is doing. It's just completed a consultation looking at what regulators can do to improve the quality and transparency of the ESG ratings and data industry.
Perfect. I think the idea of knowing what you're getting, right? This is what everybody wants to know. Okay, I'm motivated. I'm ready to allocate some of my portfolio, but what is it that I'm getting? The idea of the ratings, the labeling, and the continued scrutiny, of the practices. I think, again, it's relatively early days. There's a lot of dynamism in this space, but everyone's aware of the possibility of a need for possibility of fraud and the need for protection. And so that's obviously very high on all investors' mind, and certainly on the regulators' mind. I want to see some big picture questions, and Anders, I look at you and I think you're the big picture. I had to tell you, don't worry if it's these are unfair, but they really kind of go back to why should we be having to talk about this? Is it really something that how is this going to work, right? Is it two of the questions here sort of riff off of each other? Basically, how can we continue to achieve economic growth on the planet without harming our environment? That's a big picture question. How are companies supposed to do this if their job is to maximize profit? How do you respond to such questions?
I mean, part of these questions are almost existential, right? And is it a business? Is it an objective of a company to maximize profits? That's not necessarily a straightforward answer to that. One might also say that it's the objective of business to provide products and services that are useful to society and produced in a way that doesn't harm society. Maximizing profit is a fairly recent concept in historical terms. So it's, they're good questions, and I think that we can't get away from the fact that we are hitting some very serious planetary boundaries on especially environmental issues, and there are still social inequity and justice issues that need to be resolved. I mean, like child labor, why does that still exist? That's shouldn't exist at all, but it does. Those are things that we as a society need to address, and part of it, being able to address it, is through our economic choices. So we can grow as an economy in a sustainable way. That is perfectly possible. We just need to choose to want to do it. It might mean that we go differently, and it might be that some of the rewards for economic growth are not necessarily measured in profits. It could also be in improved air quality. So we know that, for example, improving resilience in nature improves air quality. We know that improving habitats and for wildlife reduces the probability and severity of zoonotic diseases like the COVID crisis. And these are also objectives that I would argue that society should be pursuing in addition to profit objectives. So, but if you want to look at it from a purely profitable perspective, the fact is that many of these climate issues are going to hit companies' bottom lines, and they already are. So if that's the only perspective you have, there's still an argument for going into sustainable finance.
Thank you. A huge questions. I don't know if anybody else wants to chime in on these. I would say that the people asking the questions, it's scrubbed when it gets to me. I hope it's not a SMU student, in the sense of, if you learned anything at our business school, that there's a broader mission of business. If to think about things as narrowly as that, and to think there's an inherent conflict, I go back to what Jeanne said at the beginning, and about all of this actually being integrated, so that you're taking into account all of the activities, so that there is this concept, for example, of an integrated profit and loss statement, where you bring in the fact that there are good and bad things in your activities, the impact of your activities that wouldn't just be able to be easily quantified, directly quantified, in terms of how much you sell and how much you pay your workers and for rent and other things. But those are concepts that are very much gaining ground, and really we should scope back and think more broadly about our activities. I see that the moderator is already starting to flag me up, but I want to ask the panelists to think about what do you think the next steps are for our student population who's come on to this panel to hear about this space, and in general to say, how do I get more financially literate broadly and in this specific area? Who has some pointers for our students going forward after this panel?
And I think that sustainability and sustainable finance is going to be part of your business, or is going to be part of your corporate and professional life, regardless of where you end up. This is just something that's going to affect every single job and job opportunity in the future, whether you're in fund management or go into corporate sector. So I would say seek out already opportunities to learn about sustainability. Try to educate yourself and go for these opportunities that provide you that information, because you'll be better equipped for a future that will incorporate sustainability across all business and finance segments.
Thank you, Anders. Cheryl?
And if I can add to that, no matter how you see it, sustainability and sustainable development is the greatest risk and opportunity in the century that we are facing right now. And it's not just combating climate change, which is clearly a substantial challenge, but the S, the social as well. How can we ensure equity, sustainable livelihoods, livable wages, and eradicate poverty, so that while we save the planet, there's also sustainable livelihoods for people around the world. And it's, so much fast development, but I think we're not doing the right things fast enough. the net zero goals, but we're still lacking short-term action on how the economy operates. It's still on a consume and produce and purchase model. How can we delink that into a true circular economy? And who better to ask all this question than all of the bright students and undergraduates in this room? I mean, you would be incredible leaders in the public, private, and social sectors. We are always kind of waiting for a savior or a leader, but there's no one savior and leader. It actually takes all of us. And as Anders mentioned, as you go into your role and jobs, it may not be a green job per se. You may be in supply chain management, you may be in HR, you may be in marketing, but all those roles and functions are actually, incredibly important function for a company to honor the ESG performance and policy. So I would really encourage each one of you to see how can you contribute to sustainability and sustainable development, no matter what your role and your full-time job and career is.
Thank you, Cheryl. Jeanne, I'm going to give you the last word.
I think not much more for me to say. I totally agree with what Anders and Cheryl said. Absolutely, sustainability is interdisciplinary. So whether it's business, finance, economics, political science, international relations, law, all of these are needed because it's not the finance sector moving on its own. It's not the corporate sector moving on its own. And you need governments there who are elected by people, all of you. So everything needs to tie together. And even, medical world, dentistry, veterinary practice, these also have sustainability because pharmaceutical companies have a big S component as well, and also the E, right? What happens, when the excessive antibiotic use flowing into rivers, etc. So it really is multidisciplinary, and by understanding this, and working with the Sustainable Finance Center, it helps you to up your game. Not only as an investor, as a student, as a future employee, but basically you're investing in yourself, right? To arm yourself to protect your own future and your own livelihood and that of your loved ones around.
Well, thank you so much. Thanks to all of our participants for listening in and all the good questions that came in. And I especially want to thank our three panelists, Cheryl, Anders, and Jeanne, for spending time with us and for giving us such high motivation for being looking at financing a sustainable future for all of us. It was very encouraging, as I said, to see the poll results, at least in my view, that people are open-minded and about this topic. There's a lot to learn. There's a lot of evolution, so watch this space. And thank you again. And I'll turn this back over to our MC. Thank you.